everybody. Welcome to the Sense of Things podcast. It is the first week of May. It is Small Business Week in America, and we're just coming out of earnings season. So on the show today, Ron and I are going to talk a little bit about what went on during earnings season, take a look at a little bit of that. We're going to take a look at the debt limit because that is coming up very rapidly on us, the debt ceiling, and the Fed just increased interest rates for a 10th time in a row. And we'll talk a little bit about that. Ron will cover that today. I'm going to cover leading economic indicators. This is something I've used for years, and a mentor of mine taught me about leading economic indicators. So we're going to talk a little bit about that. And then Ron's got a market outlook that we'll share at the end. So Ron, how you doing, buddy?
Good, Jeff. You?
I am fantastic. Good morning to you. It's 7:30 in Arizona right now?
Absolutely. Never a dull moment in the markets. There's always news. If there's no news, there's not much snoozing. I will say that.
Absolutely. And you went to Philadelphia and didn't get killed last week. So life is good.
It's all good. It's not bad as some of the other cities.
No kidding.
Yeah,
well, hey, let's kick off today. So, we just came out of earnings season. What's your take on what you were seeing during earnings season?
I got to tell you, I know last time we talked about, hey, we got to look out for the tech earnings. The tech earnings were blowouts. I mean, they're minting money. They're making money hand over fist, and the market stayed very resilient through the tech earnings. I know we still got some more this week and next week. I will tell you, the companies typically, they lowered the bar as usual at the end of last year and in January and February. So I think it was pretty easy for the companies to kind of leap over that bar. But I think you'll agree, you heard it as much as I did. The CEOs and the CFOs are still talking about headwinds. They're always talking headwinds, right? The Fed rate increase, the debt limit, possible recession. So they're lowering the bar even more so the balance of this year. Again, I think they're keeping the bar pretty low, and they're going to continue to through the end of this calendar year. Yeah,
I'm the same way. I think my learnings out of this, I really, it was what I was thinking was going to happen from the bank standpoint. So the big money center banks are just blowing it out. They're the benefactors of Silicon Valley Bank and some of these bank failures that we've seen. They've been the huge benefactors, and they've also gone in and tried to help out some of the larger regional banks like First Republic, which just got blasted out of the water. They had injected capital into some of those banks, and it didn't really help in the case of First Republic. They had, I think, $30 billion of an outflow from deposits. So it
was interesting. There were either 8 to 10 of the big banks that injected cash into First Republic a month ago to try and help sustain and stabilize it, and it didn't work. I mean, once those banks get some taint and some stink on them, people pull their deposits, and they could do it very quickly with today's technology. I heard a lot of stuff. The big get bigger. JP Morgan took over First Republic. You know what? I don't think they wanted them, just because of the optics and everything else. But they had a large investment with deposits. So they're figuring, hey, they're getting it for pennies on the dollar. They're getting their investment back, and we'll go from there. But I really don't think they wanted to take them over. No. But I don't think they had much of a choice, because I don't think there were many other suitors.
Yeah. Well, and I was having a conversation with one of my clients yesterday, and I mean, his feeling is, there's this global thing going on where, the big banks just want to get bigger. And I agree with you. I think they want to be strategic about what they're doing. I think the one good thing about our market here in this country, if you were to go to Europe, I mean, it's funny, when I've been in Europe, there aren't those little small regional banks in Europe, and it's a very tough market for capitalism, because you're dealing with just a small amount of these massive ginormous banks. I mean, the thing I love about our system here in the United States is we have these regional banks, and they're community banks, and they bank in the businesses in their community, which I was a benefactor of. I built a business, one of my businesses, using an SBA loan from my local bank. I went to 11 banks before I found one that would bank me, and I didn't go to any of the big money center ones because I knew they wouldn't at all. So,
Right.
I think they serve a purpose. Regional banks serve a purpose. I think everybody needs to calm down a little bit about these things. I think the reality of a lot of this is that these regional banks loan money for building commercial real estate at 1.5%, 2%, and in this environment they can't make money at 1.5%, 2%.
No,
They're
and
they're
there's a
having
lot of
to
people saying
adjust.
that's the next black swan,
Yeah,
is the small and regional banks have something like 70 to 80% of the paper on commercial property loans.
yeah.
And what's going to happen when most of that comes due in the next 2 to 3 years?
Yeah, and that's it. And you have an environment where people are moving away from being in the office on a regular basis. I talked to a new client the other day who's in a facilities position with pretty decent size. I mean, it's kind of a mid-sized tech company, and he was saying he went from like 14 people down to 4 at this point, and they're spending more time. They had expanded to like 14 offices, and they're now kind of reshuffling and rejiggering those offices to kind of deal with the reality of today
Right.
of what the work environment looks like. So I think a lot of big companies are doing that as well. They're having to rejigger what their environment looks like. It's interesting that a lot of, coming from the co-working industry, one of the most interesting things is what we've been doing for years with this kind of shared office space, and working with multiple people kind of working in different rooms and things like that. Big companies are starting to do that. Less of the office spaces and more of
Right.
these kind of shared common spaces is what a lot of these big companies are doing, while people work from home and they come in for meetings in the office.
Well, look, this has been a trend for the last 25, you could call it 30 years.
Yeah,
Technology is helping companies do more with less.
yeah,
And if the average person doesn't understand that yet, they never will.
mhm,
And not only that too, but this is another big thing. I could say it generational. You and I are basically old codgers at this point, to the point where you got to measure the output, not the input,
yep,
because there's without trashing too much of the prior generation or are the generations behind us. For the most part, people aren't like you and me that they want to work
yeah,
50, 60 hours a week to get to that next level or whatever. They want to work less. They want to earn more.
yeah,
It's just crazy. But technology is making us all rethink
mhm.
about how we work,
Yeah.
and
Well, and
doing
I
more
think
with less.
Yeah, and I think work today is measured more, like you were saying, in output, or it should be measured in output versus hours.
Right.
I think that kind of industrial mindset of working 8 to 5 every day. Well, you know what? I don't really care about working 8 to 5. I try and work as little as I possibly can, but make maximum output. In my world, even though I'm an old codger, as you put it.
I'm
But I
there
think
too.
it's smarter rather than harder
Right.
in those cases, and not just, well, yeah, working from. It was funny because I was talking to somebody the other day and we were discussing, our schedules and how you have to hustle and all this. And I was talking to them and I said, well, I basically have kind of adjusted my schedule down to where, I don't work 50, 60, 80 hours a week anymore. I mean, I work very effectively. And they're like, oh, well, so you're working you only work, you try to work 4 days a week. So does that mean you're working like 10 hours a day and the other days? And I'm like, no, I just pack more into those shorter hours during the week and get more done
Yep.
and more productive, more output, more money in today's world. So, I mean, the beauty of technology is use that to your advantage. And, going back to the point, that doesn't necessarily have to be done in an office. It can
No.
be done really wherever you're at, which is fantastic.
Nope. And unfortunately, the average American out there is not getting that, and they think that their job is more of a right than a privilege.
Yeah.
And and I hate to say it, but a lot of the economic numbers that are out there, we'll cover a little bit today, especially when you go through the LEI, the leading economic indicators. I mean, it's basically showing, you know, the average person isn't working the way they used to.
Mhm.
And just to show you, I mean, the JOLTS report, right? It had the most precipitous decline in the last couple of months than it ever did in its history of the reporting it. And the JOLTS report is the job openings.
Yeah.
For the people that don't know what that is. And for the most part, there has been more job openings than people to fill those jobs. The job opening report now is the amount of job openings have declined to the point where the cracks are widening. There's no doubt about it. And we're starting to see that.
Well, yeah, I mean, companies had these jobs open that have been sitting out there forever. And, I think that's the first indicator of, it's not necessarily layoffs. It is, okay, well, you know what, we're going to try and figure out how to make things work more, more efficiently. I was just talking with one of our folks here that has a driving school that's in my office. And we were talking that one of his, people couldn't get out of bed this morning to come in and do a drive, and the parent called him and said, well, I just can't get Johnny out of bed this morning. And, we ended up having a discussion about Panera Bread. I was like, they were the first one. I said this about 4 years ago. I went into Panera Bread one day and there was these kiosks on the right. And I was like, well, that's kind of cool. And went up and I used the kiosk, and I'm totally fine with not interacting with somebody
Self-service
at the counter. I'll do self-service. I'm fine. Even if there's somebody waiting for me at the counter, I'll come in and use that, in grocery stores and all that. So a lot of these people that are, too good to work at this point are going to find that there's no jobs, there's no startup jobs anywhere because it can be done by technology. And I think with AI and we're just seeing the very beginnings of AI. I mean, I've been using it extensively in my business for about the past 2 months. It's made me massively more productive, and I don't need to hire outside copywriters. I don't need to hire, writers for my blog and things like that anymore, because I can generate a lot of this stuff on my own. It was mainly just getting the ideas and generating the ideas and getting going. And, I produce more content today than I have probably in the last year and in the last 2 months.
You are a content creator, that's for sure.
I am, man. That's what I do. Well, let's why don't we kick into talking a little bit about the debt limit, because I think that's the next big shoe to fall here in this country. What's your thoughts on where we're at?
I don't know if it was the last podcast or two ago. I think they were talking about June or July.
Yeah.
Now Janet Yellen came out, said June 1st, and it's always a moving target, but it doesn't matter. The air's coming out of the balloon and we're getting very, very close. And as usual, we talked about this last time without doing a deep dive into politics, because both sides use it as a political football. It's become a blood sport and it's going to get very bloody. I could remember 12 years ago when, they had the government shutdown in 2011 over the debt ceiling. I think every day that goes by right now, I think it keeps inching up a percentage that I think we're already above 50% now. We could get a government shutdown.
Oh,
every day that goes by, I think we're going to get closer. If you notice, that hasn't been really on the news at all. Not that they're not talking about it. I'm talking about them meeting on it. It's basically both sides have drawn a line in the sand. And when that happens, nothing gets done.
Yeah. Yeah. And I think we've reached a point with the political parties where there's nothing that they can agree on anymore. I mean, they actually do agree on more things than they admit, but it's just like, I'm a bunch of children. I'm not going to deal with you and you're not going to deal with me. And you know what? Then we start playing these idiotic games. I remember, I think my favorite thing about 2011 was the stupid crap that the government plays when we go into one of these shutdowns and, we're going to shut down the national monuments. We're going to shut down the World War II. The non-essential things. Okay, well, you don't really have anybody manning these things, so don't go there with this crap. The best thing that happened at that time period was that group of World War II veterans that, instead of storming the beaches of Normandy, stormed the World War II memorial. That was just the ultimate, the greatest generation. But I hate that, that crap of, we're going to just close down part of this museum because, we don't have the staffing for it and all that crap, so that we can let people in the public know that, the other side didn't do the right thing. But
Well,
yeah,
and
I
I
mean,
got to tell you, it's pretty extensive what that
yeah,
shutdown was in 2011, because I remember there was a couple of kids that I coached baseball, and one was in the Merchant Marines and one was something else. I'm like, what are you doing? Like, we can't go into work today. The government shut down, and they weren't getting paid,
yeah,
and everything else. So I have a feeling that if I had to put a percentage on it, I know I said more than 50%. I
mhm.
think it's closer to 70%
I
as of
think so too.
today that we'll have a government shutdown.
Yeah,
I
I do
can't. I
too.
don't
Yeah.
see an 11th hour thing happening. I think it's going to
Mhm.
get shut down. Political pressure is going to come on both, and I think they both have to cave. But we'll
Mhm.
see.
Yeah, and I think it'll go through the summer. They'll shut down some national parks and just, show that, oh, this is so horrible and the other side's evil and all that. And probably going into it, my best guess is it'll run from June until sometime in the fall, early
Ooh,
fall, and then we're dealing with, then after Congress comes back from their, month-long vacation, then all of a sudden everybody will get together and do all that, because we're going into a presidential cycle and,
yep.
and election cycle the following year. And nobody wants to be the one that kept the government shut down through all of that.
Well, if people want to try and understand, how does this affect them?
Yeah.
Well, if you got a longer term horizon, it really doesn't matter. If your portfolio is set up for income generation, it's not really going to matter. If you're always looking at, your portfolio weekly, monthly, which is probably more often than you should,
Mhm.
as we approach the debt limit, the market will go down 3 to 5% at the minimum, in the anticipation there may be a government shutdown.
Mhm.
If there is a government shutdown, it's probably another 5 to 12, maybe 15% downside from there. And then obviously, once they come to an agreement, maybe 50% or more may return.
Mhm.
Who knows? But as we approach it, and if we get in one, people should expect at least a 10 to 15% pullback.
Mhm. Yeah, and I totally agree with you. I think we're approaching that, and some of the stuff that we'll talk about in my piece of this, talking about leading economic indicators, I think that's already, the economy is already factoring some of that in, or we're already starting to see it in that piece of it.
Yeah,
Um,
let's go on to the Fed rate, because I
yeah,
could go through some
you've got your
charts
charts
here.
on that.
I think they're going to be pretty important. Give me one sec. Let me know when you see the screen. You
Oh
got it?
yeah, it's up there.
Perfect. So let me explain what this slide is, because I have a couple of these, but it's pretty important. So this goes back, as you can see, to 1955. Everybody remembers that year, right? The
Oh
55
yeah.
Chevy. So what I'm trying to explain here is that this is basically showing when the Fed increases rates. The shaded areas is when we've had a recession and the length of a recession. What I basically did in red circles here is show you the rise or the peak of rates, and then when you see a recession. And you could pretty much see that a rise in rates, and a precipitous rise in rates, has pretty much led to a recession. Now, Tony Dwyer of Concord Genuity, I got to throw out props to him. I heard him say this a couple of years ago, actually back in 2019, that through his research, that when you get an inverted yield of the 2-year and the 10-year, and we'll go through a chart of that in a second, typically a recession is within 16 to 22 months. And you could pretty much see here, I mean, we had actually, if you want to look at it, 4 recessions in 12 years from 1970 to 82. But you could pretty much see prior to the recession in 91 and 92, prior to the dot-com, prior to 06, 07 into 08. And then, of course, even though COVID pulled forward, we were already anticipating a recession after 2019. Look where we are, folks, right? Well, I mean, we have gone up in a precipitous way. And if you don't think that we're not having a recession, then you don't believe in facts and data. So let's just keep going here. So the next one is the inversion, meaning when the 2-year rate is higher than the 10-year rate. So when the inversion happens, this is how far below we are in the inversion, meaning are we negative 50 basis points, 75 basis points, 1 basis point below the 10-year is below the 2-year. And pretty much, as you can see, once we pass this line, how quickly a recession happens within 16 to 22 months. It's predicted pretty much the last 11 recessions. This one, if you can see here, I didn't blow it up. It just was inverted, and we had a recession, obviously, with COVID. Folks, again, if you don't believe that we're not having a recession based on these facts, again, we're not looking at the right things. Now, this is the 2-year and the 10-year inversion. The Fed typically looks at the 3-month and 10-year inversion. All right, this is 1990, 2001 and 2002, 2006 and 7, pre-COVID, and here we are down here, folks. This is the 3-month and the 10-year. You can see how much of an inversion there is. So we're looking at the next 6 to 9 months. And just so you can see kind of how it overlays here of the 2-year, 10-year, and the 3-year and the 10-year, folks, we're going to be seeing something happen fairly precipitously by the end of this year, or the beginning of next year at the latest. I think it's basically a head-on train that we just cannot avoid. And to kind of help prove this a little bit, we're in an earnings recession. As you can see, the last 6 quarters, including the current quarter, looking at negative EPS growth, earnings growth in public companies. This just doesn't happen and we avoid a recession. Now, this isn't estimates, this is actual earnings. And even though companies are lowering their bar as far as what they're anticipating in earnings, again, this is negative earnings growth 6 straight quarters. So again, this is all kind of leading into the thesis of a recession in either Q3 or Q4 this year. And then Q1 and next year will be a great time to reallocate and look for growth over the next couple of years. So that's kind of where I am. Where are you?
Well, and I'll kind of lead into that with my piece of it, because, you know, one of the things I've always been a proponent of, or that I learned, was leading economic indicators, you know, because a lot of the government data that's out there are really focused on the, you know, what happened in the past, you know, so we're looking backwards quite often. So when we look at leading economic indicators, this is put together by the Conference Board. And, you know, Conference Board basically is I would call it a think tank of CEOs, of people that are in senior positions at different companies, you know, kind of sharing their thoughts and looking at economic data. And so it's always been a really good indicator too of when a recession is happening. And if you overlay this to some of the stuff that you were talking about interest rates and inversion of the yield curve, they match up almost exactly. And you know, we have a 0% line, and then we have a negative. And when we go into negative, leading indicators are indicating to us that things are kind of moving that way. And so you've got on this chart year over year change of the LEI, and then real GDP change. And, you know, real GDP change, we're still positive at this point. Typically, when both of those go negative, we are leading in, although, you know, if you looked at 2008, you know, real GDP kind of led into the middle of that recession, where the leading economic indicators pretty accurately indicated when that recession was going to happen. And we had one of the most precipitous drops from the high coming out of COVID, dropping to the point where we're at today. We've seen a really precipitous move in leading economic indicators.
It looks like the real GDP follows the LEI.
It does, and it typically lags it. So the leading economic indicators, you know, GDP is a you know, backward looking thing
lagging,
of, you know, what it is. So it's a lagging indicator. The leading indicators are typically saying, okay, this is what we see, you know, coming in here. When we look at the components of it, this is the part that I always look at, because I want to understand what's going on inside of there. So you've got, you know, leading economic indicators, we're negative 4%, the highest point we've been probably in about since 2008. As far as precipitous drop in the leading economic indicators. The financial components, the credit index was just a little bit to the negative. It's showing a little bit to the negative over this last year. The non-financial components are really what I concern. It's more of the canary in the coal mine. Consumer expectations of business conditions down 1.35%. We saw it increase this month. Index of new orders, so index of ISM, which is index of service management or whatever it is,
Yep.
index of new orders really dropped off as well. So you're seeing that forward-looking companies, and I think you were seeing that in the earnings reports and things like that. The senior leadership of these companies is saying, hey, we see recession on the horizon, so we're kind of pulling back our orders. I think if you look at the JOLTS numbers, they're looking at, hey, we've got all these jobs out there. Well, we're not going to hire people, so let's cut those jobs out. So you're seeing those compress back down. Building permits were down. Average weekly earnings down. So we're starting to see the cracks in the system a little bit from the leading economic indicators. This is the last chart I want to talk about, and this is really the LEI. When you look at it as a predictor of recessions. So you can see it's been a pretty accurate, if you look back to 2000, it's been a pretty accurate indicator of when we're in recession. And I would venture to say at this point that we are probably either in or really dang close to being in a recession at this point. And it's just not indicated it yet through the GDP. I have a feeling that you're going to start to see, as of Q2, maybe even, Q3, the numbers will report it, but you may even start to see the signs of it in Q2 here as the numbers hit in, early July, basically, that we're already starting to see the signs of a recession. We haven't seen the Fed slow down and stop raising interest rates at this point, although Jerome Powell kind of said it yesterday that, they may be looking at slowing things down a little bit. But I just, from my perspective, I think looking at the data that you have, the data that I had in LEI, for me, it's telling me we're already there, or we're getting really dang close. And, I've already been doing this with my clients up to this point of adjusting portfolios accordingly. But, I think for people out there that are listening to us and manage their own portfolios, it's the time to start looking. Either do it yourself or work with somebody that can help you. But it's time to start getting prepared.
I agree.
And making sure that you get there.
Yeah, you got to stay ahead of the curve, because if you're behind the curve, then you just got to wait it out.
Yeah. And I think that's the other big challenge is, okay, you try and get that last little bit out of the market, and you end up, getting poleaxed as a result of it. So now that's not saying, okay, you go to cash and just sit on the sidelines in cash, because the problem with that is you've got to make two right decisions. When do you get out? When do you get back in? But adjusting your allocations accordingly, I think, is much smarter at this point.
And it also depends on kind of where they are in their life stage too.
Yeah.
Certainly if you got 10, 15 or more years to go, you can make some adjustments, but in the grand scheme of things, it's not going to make a huge difference by going to cash and trying to figure out when to go back in. Because if you got 10 to 15 years to go, even if we're going to be in a recession this year, you're probably going to go through another recession, as most recessions are every 6 to 8 years anyway. So you're going to go through it again. So to try and time the market now is kind of a fool's effort.
Yeah, absolutely. So I know you had some market outlook slides that you wanted to share. So let's go ahead and
just
kind
two
of
quick
shift to that.
slides. Two quick slides to go through. Let me see here. Got the screen?
It's coming. There you go.
All right, so this is as of yesterday's close. So I know it's a busy screen, so I'm just going to explain a couple of things here, and then I got a kind of a more exploded view. So this is basically looking at about a year and a half. This is where we are right now. This is the S&P 500 chart. As of the close of yesterday, we were at 40.90. Now, I think it's very important. Some people want to know, like, why do I look at the S&P? Actually, there are other key benchmark indexes to look at. S&P is the most broad-based index, even though the top 6 stocks make up about 25 to 30% of its move. You know who they are. They're all the top tech companies. But basically, back in December and January, I had identified this price target for May, June timeframe, and we hit it when all the banking BS happened back in March. I truly believe that this is the 50-day moving average. This is the 200. I think we're going to go below this in the next 2 weeks, and we'll probably end up here, which is that March low, probably in late May or even the June timeframe, right around, of
Debt
course,
ceiling.
what were we just talking about? The
Yep.
debt ceiling discussion. So it's just timing at this point, but I think that's the short-term outlook as far as where we're going. And to kind of look at the exploded view, just trying to show people, this was the March low here. All right. This is the close of yesterday after the Fed raised a 0.25%. And again, if you're trying to figure out what this means, that's about a 5 to 6%, 5.6% downside from here within the next 30 days, 30 to 45 days at the most. I'm not trying to sound doom and gloom. I'm not trying to, create fear. This isn't fear, folks. What you should be looking at there is opportunity. And as things pull back, and probably it'll pull back even further, whether or not it goes to the October lows, which is about 3,300, where a lot of people are seeing potentially go, to be determined. It's based on the breadth and depth of where we may be in the recession and how much fear is really going to be created more by the media than anybody else. We shall see. But you got to look at this as an opportunity, because there's a lot of high quality stocks and public companies out there. That's when you want to go in them, when they're on sale. So you got to look at this as opportunity, not in a fearful situation.
Absolutely. Yeah, I totally agree. And I 5.6% decline, although on the chart, it looks like a horrible, huge precipitous drop. I mean, 5.6% is not that much overall.
The normal correction.
It's a normal correction, and it's really not even almost a correction at that point. I mean, it's, peak to trough, okay, you got to get at least 10% to even be considered a correction. But it's an indication of, okay, do we then blow past that line? Do we sit there and bounce off of it, or do we continue on after that point? But I agree with you. I mean, there's a lot of companies out there that I love that I just won't buy right now. And there's a lot of industries that I won't buy right now because I think they're economically sensitive. Like I've said in the past, I run mostly a portfolio of sectors versus, kind of a diversified portfolio. So I'll tend to stay away from things at certain time periods. And, right now, I mean, there's areas that I just won't even invest in because
what are the top 2 or 3 sectors that you wouldn't invest in? Because, my top 3 is banking, retail, manufacturing, because those are the 3 that are going to be hit the hardest, other than tech, as far as layoffs are concerned.
Yeah. And I break that up into, manufacturing, I break up into consumer discretionary versus consumer staples. So consumer discretionary, retail, and, that and the financial industry. Finance right now, I know the big money center banks are fine, but I just don't want to stay. I don't want to be there right now. I want this thing to clear up. And I think there's going to be huge opportunities to invest in that area going forward. Once we kind of get through some of this craziness, once the Fed stops raising interest rates, I just don't want to fight the Fed right now. When it comes to that, I'd rather be in stable things that people are going to continue to use. Technology is kind of an interesting animal in that, I think it's blowing the covers off the ball. And it's an interesting animal because it's become so ingrained into our lives that we tend not to, okay, I might give up buying a new car before I'm going to give up my Netflix subscription at this point, or I'm going to give up my new car, but I still need to upgrade my phone, this year. But I think the Apple numbers were interesting for me because although Apple's blowing the cover off the ball, it's really some interesting. It's interesting to see on that consumer cycle of upgrades. In this current economic cycle, are people going to be spending $1,000 or $1,100 for that new phone, or are they going to let it, go for a couple more years?
Well, a lot of people see it as it's an essential purchase. It's an essential extension of their life. And without it, it's like losing an arm.
Yeah.
So the answer is yes, they're going to keep buying the iPhones and the Android phones and possibly the watches. I don't have an Apple Watch, but but yeah, people are going to keep buying it because it's their lifeline to the world, to the way most people see it.
Yeah. And it's interesting, the PC cycle. I mean, I think that's, when I looked at like AMD numbers that came out this week were just atrocious. Well, a lot of that is that cycle that, AMD really doesn't have a product for the phone. Their product is primarily PC and desktop type, equipment, and that, people are just not upgrading it as much, but they'll upgrade that phone because it's become such a useful tool for them.
Yeah. Well, by the time we get to the next podcast, we'll be able to talk about the debt ceiling a little bit more. And certainly if we broach those major 50-day and the 200-day moving average on the S&P, we'll certainly have a lot more content to discuss about the next leg.
Absolutely. And, for those of you that are listening to this, one of the things that Ron and I are going to be doing, and I'll be doing this week, is I'm going to actually do a quick, like 7 to 10 minute thing on the leading economic indicators that I talked about on here. Those will be on the channel. So make sure that you subscribe to the channel and put the notification tab on so that when we knock those things out, you'll be aware of them. And it'll be just a quick hit to go a little bit deeper, not necessarily, what's going on today, but understand what the leading economic indicators are and what they typically mean for you. We'll be doing that just as things kind of come up, GDP and all these different indicators that we look at. We'll be doing those little short things for you to keep you informed. We want to help you and make sure that you understand what this is and why we look at this and why we see it as important.
Absolutely.
Excellent. Well, folks, thank you so much for listening in today. I hope this was informative for you. Once again, if you haven't, it's time to take a look at your portfolio, not run for the hills, not put it all in cash, but look at your allocations, look at, consider your time period, and, look at that. And certainly if you don't feel comfortable doing it yourself, find somebody that can help you, that can look at this and understand it and help you to reallocate your portfolio. So thanks a lot. We'll see you guys here the very next time.
All right, Jeff, take care.
All right, buddy.